Thanks everyone for joining tonight. My name is Jim Brady. I'm the Senior Director of Sales for Henry Schein Financial Services. And on behalf of our entire team, thanks for joining our annual year-end tax planning webinar as part of the Henry Schein Dental Business Institute webinar series. This is actually our third tax planning webinar that we've completed so far this year, and our second one with Bob Gray. Obviously a very well-attended and thoughtful topic tonight. As a reminder, this webinar does not qualify for CE credits. Tonight, I am joined by Bob Gray. Bob is the owner and partner of Gray Pilgrim and Associates and a founding member of the Academy of Dental CPAs. Bob's going to spend some time tonight discussing 2023 tax planning topics, including making sure you're claiming your ERC refunds, maximizing your QBI deduction, and importantly, Section 179, as you strategize on those kind of year-end equipment purchases as year-end quickly approaches here. A couple quick housekeeping items. So Bob's got about 35, 40 minutes worth of presentation, and then we'll have plenty of time for questions and answers afterwards. So I would ask that you do hold your questions until the slides conclude. I mean, you can keep the questions if you want to in the question and answer chat portion of the Zoom. And then we'll read through all of those at the end of the presentation. So look forward to all those great questions. We normally have a lot of great engagement, so please don't be shy. So without further ado, Bob, over to you.
All right. Thank you very much, Jim. I appreciate it. Welcome, everybody. We're talking tonight again about 2023 tax planning. We're going to be talking about a lot of different concepts tonight, but I wanted to start out with the disclosure. Of course, we're talking about general educational topics. We're not trying to talk about individual tax strategies for any one individual person. You always have to make sure that the things we talk about tonight, that you run by your tax advisor and that they're right for you. Having said that, let's get started. I am Bob Gray, very proud to be one of the founding members of the Academy of Dental CPAs. I'm also an instructor for the ADCPA's Business of Dentistry courses that we've run. Instructor at the Dental Business Institute, and I have lectured all over the United States to different study clubs and things. So I think that's why I got picked to be here tonight. You know, when I'm not helping dentists be better entrepreneurs, my wife and I love going to Napa and seeking out these 100-point little boutique wines from the off wineries, the smaller ones that don't seem to get as much presence. So you'll have my email address at the end of the program here. Anybody else is another wino like me, if you have your favorite winery in Napa you like to go to, send that to me. I'd be curious to see what comes of that. A quick shout out to the ADCPA, though. Sometimes I think the ADCPA is the best kept secret on the planet. We're a whole group of accountants, all of whom are dedicated to working with dentists. And we don't just happen to have a lot of dentists as clients. We're actually in the space. We either teach, as I'm doing tonight, we write for dental economics, where we're working to help dentists be better entrepreneurs. And we're all over the United States. If you go to adcpa.org, click on the map, you'll find an accountant and a practice near you. People ask me all the time, now, what's the difference, Bob? Because, why would you specialize in working with dentists? Aren't all the tax laws the same? But I would tell you that if you really look at what the difference is, dentists don't know which questions to ask, right? They're talking to their practitioners, they're talking to their CPAs, but a lot of times these CPAs expect them to know what to ask. We know what dentists really need and what they should be having for tax deductions. So I always laugh and just say, if your current accountant can't point to tooth number 8 or doesn't know mesial from distal, switch to one who does. Tonight, I want to talk about the legitimate ERC refunds. We're also going to talk about maximizing that qualified business income deduction, the QBI. We're going to make sure that everyone understands, if you have a state income tax, what that's pass-through entity tax is, because it's certainly something you want to take advantage of if you're in an eligible state. We're going to talk a lot about Section 179 and bonus depreciation, because I don't think dentists really understand the financial impact that really has. It's easy to say, oh, that's a great tax deduction, but I want to show you an example here so you can see the real economic impact. Talk a little bit about retirement plans, but I am going to leave a lot of time at the end for questions. I do try to field as many questions as we possibly can, so if you do have them, don't be afraid to type those in, and I'll see what I can possibly do about answering all of them tonight. Let me start out with just a couple sort of housekeeping easy things. The standard mileage rate for people that are using standard mileage for tax deducting their business use of their vehicles, it jumped up because of the price of gas predominantly to 65.5 cents per mile. But one of the other things, this residential clean energy credit of 30% has been around, but in 2023, it now applies to battery storage technology. So for any of you who are considering the Tesla wall or some of these battery backup systems, the federal government is willing to pay 30% of the cost, including installation, to put those in your home. So just realize that credit was expanded this year, and it's pretty useful. 30% is a lot of contribution from the federal government. I want to talk about itemizing and maximizing itemized deductions. A lot of you know about the standard deduction. A standard deduction is just the amount that you get to take if you can't prove any deductions even at all. It's just a gimme. It's an amount. You'll see at the top there, for a joint taxpayer, it's $27,700 for this year, which again means I don't have to have a mortgage. I don't have to have any of those other kinds of deductions. I still get to take this. But it's for single people, it's $13,850. So a lot of times what happens, if you look in the center column here where it says even gifting, we're talking about charitable contributions now. Take a typical taxpayer whose tax deductions for real estate taxes and income taxes is limited to $10,000. That's called the SALT limit. So no matter how much higher it is, that's the max. Maybe a mortgage interest of $13,000, and they give $4,000 perhaps to charity every year. Now they have $27,000 in actual expenses, but they still get to take $27,700, even though they'd have those deductions, again, because the standard deduction was higher. But look what happened if you went back to your charity and said, hey, I'm accustomed to giving you $4,000 a year. How about if I give you $4,000 this December, and instead of giving you $4,000 next year in January or whatever, I'll give you another $4,000 this December for $8,000 this year. As you can see in the center column, giving $4,000 a year didn't do anything to get me any tax breaks, but loading those into 1 year like this and making the timing your gifts saved this particular case $1,320 in federal tax. So just realize that if there's an opportunity for you, might try to work around that limit of itemized deductions. I want to talk a lot tonight about the ERC. It's the employer retention credit. There's been a lot of talk about this. We're going to talk again a lot about the good and the bad of this tonight. But the ERC, just so everyone knows what that was, it was a credit that was given by the IRS for anybody who sustained a full or partial shutdown of operations due to orders from an appropriate governmental authority. You got to have that, realize that's a limiting factor. You weren't shut down because you thought it was unsafe and all your employees wouldn't come to work or whatever else. It had to be under a government order. Or you had a loss in actual gross receipts. It was a 50% during 2020. In 2021, it dropped down to a 20% drop. You could also qualify as what's called a recovery startup business. So if you started a business in the midst of the pandemic and you didn't have any prior revenue to compare it to see if it declined, you are also eligible for one of those as well. It's a great credit. And I think for anybody is there, you want to definitely take it. Here's a quick example, though, of one of these, government mandated shutdowns. This was just a chart I pulled up off the internet, but if I pick Arizona as the state, you'll see that their actual stay-at-home order began on March 31st at that first red arrow. It was lifted on May 15th. So it's really for the state of Arizona, that would only be that 6 weeks that if you had payroll and you had your practice open and were trying to see patients or paid your employees continuously to stay home to try to, retain them, that you were eligible for this credit. Now that's the governmental, shutdown portion. Then you also had to look at your revenue test. So again, those are the two things that made you eligible for that credit. Again, as I said, it was 50% of qualified wages in 2020. There was a limit of $10,000 per employee. So that in 2020, the maximum you could get was $5,000 per employee. They expanded it in 2021 so that it's 70% of the qualified wages up to 10,000 per quarter. So now in 2021, if you had 3 different quarters that you qualified, you can get a $21,000 claim for each employee. Again, with the 5,000 before, that's $26,000 potentially per employee. And again, it's slightly reduced if you were one of those recovery startup businesses and you had less time involved, you were not eligible for the full 26,000. Again, but if for many of the people that did open, remember that this credit is available. You just had to have annual gross receipts of less than $1 million and started business after February 15th of 2020. So you're one of those in-between businesses that had no way to compare revenue between a prior year. And you actually had to have employees. Here's the real problem. I bet you everybody listening to this program tonight has been bombarded by ads like this one that say, hey, you could get $26,000 per employee. And it's like free money, everything's grand, it's all wonderful. You know, look how, again, they're talking about, in this case, that the average return is $200,000 per application. We certainly wouldn't see that in dentistry as a lot, even for people that were eligible. But the problem is that there's a lot of bad actors out there. I don't know about this particular company, but I would just tell you that there are a lot of bad actors out there. And what they're saying is that, hey, you're eligible for the 26,000. They don't really go through the qualifications to say, are you eligible? They just say, hey, you're eligible. But then many of them take enormous fees for filing these simple forms to get these credits back, and it's going to be a problem. The IRS has basically said, you know, we're worried about a lot of these claims. And the problem here is, let's say they had one of those businesses that got $200,000. They may have paid as much as 35% of that money as a fee to the company that prepared those claims. So now they're out $70,000. They got $130,000 from the government. Here's the problem. If the government comes back now and says, well, yeah, but that was a false claim, they're not only going to want the $200,000 back, they're going to ask for penalties and interest and everything else. Now it's $300,000. But you only got $130,000 net in your hands, and you got to pay back $300,000 if you're wrong. So I'm really encourage anybody that if you think you've been, you know, sort of a victim of one of these refund mills who told you that you were eligible, regardless of whether you were or not, you might just want to consider this, because here's the problem. The IRS has put an absolute, you know, crosshairs on these ERC claims. They put out a notice quite some time ago that basically said there's a lot of people improperly claiming the ERC credit. And they're going to make these people repay. They're going to have an entire audit program now dedicated to get started on this program. So I would just tell you that, again, it's an issue. As of September 14th, the IRS said it was such a problem, they were going to put an immediate moratorium on even processing any claims until they could get a better handle on how to tell the difference between a fraudulent one and a regular one. But they go on to say that they're going to be, you know, talking about criminal referrals for the people that are over. So again, I would just tell you that if in fact you got a refund that you're suspicious about, you might want to consider the possibility, because they have a repayment program where you basically come forward and say, oops, I think I was wrong, or you can stop a claim, you can reverse a claim that's been filed. So there's a number of things, but talk to your accountant and make sure that you think you're absolutely eligible for that ERC claim, because the consequences could be pretty bad. Let me talk about this qualified business income deduction. This thing came about in 2018 with the tax changes back in that year. Basically what it says is that a business owner could take up to 20% of their income and actually ignore it, as it's just a tax deduction of 20% of your income. The problem is it does not apply to W-2 wages. So if you're an S Corp and you're taking your money from that corporation in the form of a W-2 and taking very little of what I'm going to call dividend or K-1 income, there's very little left for you to plan for this 20% QBI deduction. So again, what people say to me is, well, then Bob, why don't you just stop taking salary and take it all as dividends? Well, the IRS has a requirement that you have to take a reasonable salary. There's, you know, court cases after court cases of what that means, but I think that sort of the litmus test is if at least 50% of the money that's available, you know, if the practice net income was $500,000, you'd want to take probably $250,000 out of salary and the rest. But again, your individual situation may be different depending on how many associates you have or what the situation would be. But just realizing that balancing those W-2 wages and your K-1 really, really helps. We're going to talk about an example coming up here. I'll show you that QBI deduction. I want to jump into talking about dental equipment because, again, this is the topic that I think a lot of people who are maybe contemplating, is this the year that I make that purchase, whatever that purchase would be, how is it really going to affect me? So there's a couple of things. You hear about accelerated depreciation. So that's section 179 and bonus depreciation. Those are the things that are considered accelerated. Section for 179 limit is 1.16 million in purchases for 2023. Maybe for a really large practice, that would be a ceiling to hit, but you can't spend more than 2.8 million to be qualified. If you spend more than that, you lose the 179 deduction altogether. And that's meant to keep large businesses away from being able to take this deduction. Bonus depreciation is 80% for 2023, but it's unlimited. So you could buy $5 million worth of equipment and get 80% bonus depreciation. And it is for newer used equipment. The trick is that this equipment has to be placed in service before the end of the year. I know a lot of clients say, well, can't I just, place an order and put a deposit down or sign the contract? And as long as they get it to me in January, is that close enough? The IRS says it had to have been available for use, like on the floor, plugged in, ready to go. It didn't have to be actually used. It had to be available for use. So realize that's an important factor. So you want to make these decisions as early as possible. And people say, well, what's the difference, Bob, between the 179 and the bonus? Why is one better than the other? Well, I would tell you that some states don't recognize the 179 limits. Many states, California, for instance, when the 179 was capped at $25,000 many, many years ago, they just froze it at that and said, okay, that's all we're going to let California residents have. So you have to look at the difference in your particular state, whether bonus or 179 is better for you. Again, talk to your accountant who will know how to maximize that benefit for your particular state. But look what happens. I want to give you an example here of someone who purchased $150,000 worth of equipment on November the 1st. And let's say it's placed in service. And let's say that they financed it with one of the programs that are offered with 6 months of no payments, compound interest, and you get time to perhaps integrate this new technology into your practice. The refund or the reduction of taxes you would get for 2023 is $45,000. But what everyone forgets is that also affects the amount of estimated taxes you have to pay for next year as well. So that means that on April 15th of 2024, when your next estimated tax payment would be, you can pay $10,000 less on that one too. So let me go back again. All you do is sign a contract and purchase equipment on November the 1st, and you have $55,000 more in your pocket right now than you would have had if you didn't buy the equipment. I mean, that's a lot of cash flow to help people get over the angst of, again, learning curves or implementing equipment or new technology in their practice. It's not just this year, it's next year as well. Now we're going to talk about, again, looking about how that also can flow together with the QBI and this 179 in an example coming up. So the reason it affects your purchase after 2024 or your taxes after 2024 is that you're required, if you make more than $150,000, to pay 110% of the tax from the prior year for that safe harbor. It could be as much as 90% if you're just going with whatever this year is, but that safe harbor is the 110, which means the lower your taxes were for 2023, the lower that safe harbor minimum is for 2024. So that's why it has such a big effect on paying that. And again, in this example, we would be cutting another $40,000 off the cash flow in 2024 for the same dentist. Now that money would have to be paid, but not until 2025. And I would guarantee that for most of you, if I said to you, hey, you can keep $40,000 and come, and it's interest free until April 15th of 2025. That's a pretty good deal. So realize that does apply, and it applies to all entities. Whether you're an LLC, sole proprietor, S Corps, everything does. And an S Corp, it just makes you adjust your salary accordingly. So you want to make sure that you've done as much planning as you can. C Corps can do it, but they have to start even way earlier to get the planning out, but it can be done. Here was the example that I wanted to show you about what this equipment might have done with both the 179 and the qualified business income. Look at the section in the center that says without section 179. So this doctor had practice net income of $495,000 and some adjustments and itemized deductions, and taxable income was $466,000. The problem is with this QBI deduction for professionals, it's limited. If you see that at the top of the screen, for joint taxpayers, if your income is higher than $364,000, it starts to actually phase out. If it's higher than $464,000, it's zero. You basically phased out completely of the ability to take a QBI. So again, look at this doctor who was at $466,000. Without this equipment, phased out, no 20% tax break. And this would just be an LLC, or it could be a Schedule C filer. But look what happens if we took that $150,000 off with Section 179 of this equipment. Now the doctor's taxable income drops below that threshold, and they're eligible to take a $69,000 tax deduction on top of the $150,000 deduction that they got for buying the equipment, just because they were now filling that QBI window. Look at the difference. $150,000 worth of equipment. You saved $65,251 just this year. Again, that's not 2024 and all the things that go on there, just this year. For this particular doctor, that thing expands because of that extra $69,000 deduction. So this QBI thing can be very, very powerful. And make sure that when you're looking, if you have the ability to plan your taxable income and make purchases accordingly, this is a great year-end strategy to lower your taxes significantly. Also want to talk about the pass-through entity tax. It's called PTE. Back in 2017, when the state and local income tax deductions were limited to $10,000, everyone cried foul. I mean, if you're in a state that has, state income tax, especially people in like New York and California and places with really high state income taxes were crying because that really cut their itemized deductions. What the states did in reaction to this is said, well, look, tell you what, we'll get the cash flow a little bit sooner. And what we're going to do is let you have a tax deduction, because we're going to call this an entity responsibility to pay these taxes on behalf of the owners. Therefore, this becomes a tax deduction. It's under the category of taxes paid by your practice, and it's deductible on the federal return. That makes a really big difference, because now you couldn't deduct anything more than $10,000. And for many of you, just your real estate taxes burn up the $10,000. You don't get to deduct any of your state income taxes. So using this method really does make a difference. And if you're in one of the states that's listed there, check with your accountant, because you really want to make sure that if in fact you're in an eligible state, you're taking advantage of the PTE. Just a really quick example I put in here. Here's a doctor that was a S Corp with a W-2 wages and K-1 income. And you can see, because of the K-1 income here, if they paid $17,500 in state taxes by the practice, it lowered that K-1 for federal purposes and saved $6,100. So that's a pretty big deal. I mean, that's a lot of tax savings just for paying the same amount of same amount of state tax. It's just a question of who paid it, the doctor personally or the S Corp. So keep this in mind. One of the other tax deductions I want to talk about that I think gets overlooked quite often are two things: cost segregation studies, but also relocating from leased space. What a lot of people forget is, let's say I went into a leasehold improvements. I was in a landlord-owned building, and I put hundreds of thousands of dollars, let's say $300,000, back in 2013. And now I've outgrown the space, and I want to relocate now in 2023. Because of their 39-year depreciation rules, you still have $215,000 of untax deducted leasehold improvements. And the thing is that when you abandon those and move, they're immediately tax deductible. And a lot of people forget that's a big tax deduction to help get over the cost of the move and to give you an incentive from a cash flow and tax savings to make that move. But I also want to talk about cost segregation studies, because again, this is something I see missed quite often. It's what I call how to turn studs and drywall into Section 179. Basically, what this was a Hospital Corporation of America audit against that won against the IRS. The IRS says you're supposed to take a building and depreciate it over 39 years for commercial property. It's really 40 because you get a half a year the first year and a half a year the last. So it's 40 actual years it takes to do it. If a typical $400,000, $1 million building, you can see about $10,000 in tax savings every year, but for 40 years, that's a long time to wait. If you break the building down into its components, you might just get as much as, or I'm saying almost as little. I've seen way higher than 20% of this turn into 5-year property, which is basically like dental equipment. The 7-year property also. That means that in this particular case, this would have saved an additional $80,000 in income taxes over the first 5 years. And when do you need that deduction the most is when you just took out a big mortgage on a brand new building and you've got a lump in your throat, right? And so this is something you really want to make sure you've taken advantage of. This is how there's a lot of numbers on here. This is how the samples typically look. They kind of show you exactly what the potential breakdown is. I show this because it's $1 million building, but also if you did tenant improvements, you don't need to own the building in order to do a cost segregation study. If you did a big build out in a space that you're leasing, you want to consider this as well. And again, if nothing else tonight, just remember in this green column here is a building broken down into multiple pieces. In the yellow box, it's not. And the yellow box is not the way you want to go. Let me give you a quick example. So I asked people what this is, and you would think that you'd say an outlet. But the answer is, well, I don't know until I know what's plugged into it. Because if a fax machine was plugged into that, now that outlet, all the wiring that goes back to the breaker, part of even the building permit costs, and this turns into like a $380 immediate tax deduction rather than 39 years. Same thing for like a sconce or just decorative lighting. Immediate tax deduction, not 39 years. And all the infrastructure, all the wiring, all the plumbing, all the things that go into your building that they're dedicated to helping drive your dental equipment are dental equipment now. They're no longer building. What doesn't qualify is load-bearing walls and the roof, and land never qualifies. Land is never tax deductible. So just again, if you've done a building project in the last few years, you want to think about this. The other thing you can do is time your study. Let's say you built a new building and you bought $300,000, $400,000 worth of new equipment, and so you had plenty of tax deductions that year. If you then wait and do your cost segregation in year 2 or year 3, you can go back and catch up on all the depreciation that could have been taken in those 3-year period and take it at a time when your income's higher. Because remember, it doesn't do any good to get your taxable income down to 0. If you get it down to 0, you've really actually lost in the big picture. Because remember, if you can see the brackets on the left here, taxes are only 10% up to $19,900 for married individuals. And that's on top of the itemized or the standard deduction, right? So if you used a lot of this equipment or a lot of this cost segregation study to save 10%, rather than waiting till your income is higher and you can see might be in a 35 or 37% tax bracket, you really wasted some of those deductions. So you definitely do not want to just arbitrarily say, oh, I want all my 179 this year. I want all my bonus depreciation. I want to get all my deductions and pay 0 tax. That's actually wasting some of those benefits and some of those deductions. Try to plan to take them at least at that 24 or 32% tax bracket, where you're really getting the bang for the buck in the tax savings. Taxes are on sale when they're 10 or 12%. So I always encourage clients to try to at least stay in that 12% tax bracket on purpose, because I think, again, taxes are on sale at that point to me. Quick thing about HSAs, Roth IRAs, and 529s, because those are obviously things you want to consider for tax deductions in any year. The limit for HSAs, the health savings accounts, is $3,850 for self and $7,750 for families. If you're older than age 55, you get a $1,000 catch-up, so that'd be like $8,750 for a family. That money is tax deducted when it goes in, and even if you turned around and took the money out 5 minutes later to pay for medical expenses, it's not taxable, and otherwise the medical expenses probably would not have been deductible for most folks. So realize this can be a great opportunity if you have high deductible health insurance. The IRA limits this year, $6,500, again, $7,500 if you're 50 or older. And the contributions to 529 plans are considered completed gifts. So the current gift tax minimum is $17,000 per donor, per beneficiary. So that means like a husband and wife could give $34,000 to a niece or nephew, to a child, and put it in the 529 plan each year and not have it be subject to gift taxes. So a little primer on those. I want to talk a little bit about selecting the right pension plan, because we do see a lot of people that don't have the one that they really should have, or the one that's consistent with their goals. The simple IRA plan is a great place to start out. If you have a brand new practice, you have limited cash flow, you've got a lot of building to do. The maximum contribution is $14,000 for the owner, but that's a good start, right? It's better than an IRA, so it's a good place to start. But when you're able to, you want to move up to a 401k plan. Those, voluntary contributions for that plan are $22,500, $30,000 if you're 50 or older. When you go up to that next step, maybe again you're an empty nester and your house is paid off and you've got lots of income. You could actually be as high as $398,000 as a current 1-year tax deduction for the contribution to a defined benefit plan. And if you put that together in a combo plan with a 401k, it's $471,500. Realize that that's, again, more than many people would want to put away. We'd all want to put it away. It might be able to put away, but I just want you to realize, as you look at all these different options, you might have the wrong size shoe when it comes to your pension plan. Make sure you've got the one where the annual contributions fit your goals for retirement. One other thing I see missed an awful lot. So when you go to dental school, you're required to buy dental books, loupes, an articulator, maybe hand instruments, all sorts of things that went with the clinical portion of your education. And when you bought those for educational purposes, they were not tax deductible. However, if you graduated and went out, as many doctors do, and become a 1099 employee, I say not employee, a 1099 contractor, where you start your own LLC and rent your time out to other dentists, on a subcontract basis, you now have the ability to have all those things placed, or at least available for use, right? So go back and pick up all of the used costs at that time, whatever the fair market value was of all those things that you bought. Bring them in and convert them from educational to business use, and now they're tax deductible. So make sure that for these young doctors who have started their own practice, that you pick those items up. Another thing I see often overlooked is the use of a family limited partnership. Now, this is a special type of partnership where all the members of the partnership are family members. When the IRS has a thing called the rule of attribution, which means that you cannot have tax deductible sales going on between spouses. You can't have, and you're all considered one for family purposes, for tax purposes. But the way that this benefits the family limited partnership is, let's say that you put your building in a family limited partnership, and the dentist is the only voting member, and the rest of the family members that are there are limited partners. Those limited partners can actually receive distributions now out of this family limited partnership, regardless of their ownership percentage. They can also have, have distributions of income legally. They don't have to work. They can be an owner of the building through this family limited partnership and get distributions of income as well. Again, it's going to be a really excellent way to help a needy child. And we have some clients who have special needs childs, but also some ones that just, kind of hang on the checkbook, if you know what I mean. And so sometimes this can be a very nice way to make the money that you have to help your kids be tax deductible. Some of the key takeaways tonight, again, tax planning is complicated. I just urge every one of you listening tonight to talk to your accountant way before April. I mean, it's too late. If you treat your accountant as an archaeologist who just blows the dust off what already happened and fills out tax forms, you're never going to be able to sort of drive the bus and steer it in your direction. You have to do advanced planning to come up with the concepts of how to minimize your tax this year. realize how big that equipment purchase was in that example that I showed you on your tax liability, especially considering that it potentially pulled that QBI deduction in. And again, if you're in a state where you have to pay state taxes, then you're eligible for that PTE. Look at the savings that did in that one example, over $6,000 for a doctor. Same amount of state tax. It was just a question of which checkbook paid it first. And again, choose wisely before that automatically taking accelerated depreciation. When you get your taxable bracket, taxable income down below in that bracket of 10 and 12%, I think you're not really getting the bang for the buck on these tax deductions. You're wasting them. You could pay, less tax, but it's very much more expensive. I mean, you get double the bang for the buck if you just go up one tax bracket to the 24% bracket. And you can turn studs and drywall into equipment. People often overlook this, but I'm telling you, if you do a cost segregation study and you plan it well, especially if you can do one of those where maybe you do it in year 2 or year 3, and you can do these as much as maybe 5 years out, depending on whether you've had a project in the recent past, and take significant tax deductions for these. So I would definitely encourage you to try to talk it to your accountant about whether or not you are eligible for cost seg study on the capital improvements in these things that you've done. I promised I would leave a lot of time here at the end for questions. There's always been a lot of interest in this in the past, but I also have my email address up there in the far right-hand corner. It's bob@gpallc.net. If you have specific questions that I can try to help you with, hopefully they're relatively easy. If you send me one of these things that requires 20 hours of research, I'm going to cry foul and say, we're welcome to hire us to answer the question. But for a lot of the easy questions, I don't mind, trying to help out dentists. I've been in the business of trying to help dentists my entire career. So if you have an easy question or something simple that you think you want to pass along, feel free to email me again. Or if you have one of those great little wineries in Napa that you want to send me a suggestion about, we want to use one of those as well. So let me see if we have any questions.
Thanks so much, Bob. That was really wonderful. And yes, we have a bunch of questions that have come in. So let's get started. This one is from Dr. Jenny Gian. Isn't the COVID shutdown applicable in 2019? It's been 4 years since then.
It's not. No, the 2019 is the year they used as that measuring stick to say, okay, because it was only started in 2020, I guess in early March of 2020, officially year for the mandate. You're using 2019 as the year to measure whether you lost revenue in 2020. So again, for the ERC claim, if your Q2 2020 total patient collections were at least 50% lower than they were in Q2 of 2019, you're automatically eligible to potentially do the calculation for that ERC. Now, you're not allowed to use the same money for the PPP loan forgiveness that you use also to claim the credit. You have to coordinate those, and you got to make sure that you're not using the same payroll dollars twice. But it's the 2019 revenue that becomes, again, that yardstick, and then you compare 2020 to that to see if you're eligible.
Thank you. We have another question here from Dr. Robert Chong. For ERC, am I correct that any ERC refund obtained should trigger an amended tax return for the period covered? For example, a refund for the first quarter in 2021 would require an amended 2021 return. When I received a refund from the IRS, it was for refund interest and tax credits. For a corporation, however, this is the second question in that same question, how is the tax credit applied when on a number 1120 tax return? Interest is reported on a current return.
Okay. So yes, when the IRS made this announcement and they created the tax code for this ERC claim, what they said was, we want you to reduce the deduction that you took for payroll in the year that it applied to. So in other words, if for 2020, let's say you had an employee and you got a $5,000 tax credit, but you didn't get it even until 2022, they want you to go back and amend your 2020 tax return to reduce your salary deduction by that $5,000. I would tell you, and again, that's the correct answer. Now, let me tell you what an awful lot of accountants are doing. And I think the AICPA and a number of other accounting boards are pushing the IRS to consider this as a possibility. I know a lot of other fellow accountants have taken the position that, look, we're cash basis taxpayers, which means we only pay income tax on money when it's received, not, you're not based on patient charges. It's got to be a deposit that went in the checkbook. Therefore, if I'm on the cash basis, if I didn't get that refund until 2022, it's not going to be taxable income to me until 2022. Now, again, that's not what the IRS says officially. I know it's what a lot of people are doing, however. I'll let you talk to your preparer about what advice you want to use, but a lot of people have taken that position. Now, the interest is always taxable in the year that it was actually earned. So when you get interest on a claim like that, if it came in 2022, that would be interest income on your 2022 tax return. But even if you take the step to amend, you would only be amending for the actual tax credit itself. But again, those tax credits, I don't know of anyone who received them in the year that they were actually claimed, especially 2020, because they were still working out the rules as we went into 2021 for how you were actually eligible. So Congress was way behind the ball. But I hope that answered your question.
Thanks so much, Bob. This next is more of a comment that I'm going to turn into a question. It's about the 529 plans. Do they, quote unquote, rip you off?
Well, the short answer is no, they don't rip you off, all of them. If you go to, if you just Google 529 plans and you Google their, quote, quality scores, you'll see that some states and some programs have much higher fees than others do. Several states, or several of these programs are rated pretty high, and you don't need to be in the one that's for your state. I mean, I know a lot of these prepaid college programs, which are also under that 529 banner, have gotten a lot of bad press because the cost associated with some of those that the states have plugged into their overhead have been pretty high. But I would tell you that, again, for the most part, most of them have been at least reasonable investments. But they're not, again, because they all have fees and costs associated with them, like any other mutual funds, they're not the cheapest way to invest money.
So interesting. Thank you, Bob. This next question is from Dr. Susan Ho. If you finance a piece of equipment but do not start paying for it until 2024, can you take Section 179 for 2023 if the equipment went in before January 1st of 2024?
Yes, that's the good part. So there's no obligation to actually pay anything towards the loan. The only thing you have to do is sign a promissory note in 2023. That makes you obligated to pay this money back. And that's the same as your credit card, for instance. We're off subject here, but let's say you swipe your credit card on December 20th to buy something that's tax deductible for the practice, but you don't actually pay the credit card until January of 2024. That swipe on the credit card, when you pull your credit card statement, that money should be posted back in 2023 as a tax deduction. And then the offsetting entry is I owe this money to my credit card. Then when you pay your credit card in 2024, it just takes away that liability called my credit card. So make sure that, again, there's no obligation to actually pay for things that you've already swiped or made a commitment for. You just have to have signed a contract.
Thank you so much for that one, Bob. We've got another comment here from Tiffany Delaney that I am going to attempt to turn into a question. The comment is self-employed health insurance options. What are those?
Well, there's two different things. One is the health insurance, and you've got a lot of options. If you're talking about the government offered options for the programs that they offer, they have a lot of different programs out there where they can go for either high deductible, low deductibles. They have the silver, the gold, the whatever plans. That's just if you're buying them on the exchange from the U.S. Self-employed health deductions, however, means that anything that you pay, if you are self-employed, whatever you pay for the cost of health insurance is an additional deduction up to the total amount of your net income on your tax return. So if you're an independent contractor and you're paying for your own health insurance, make sure that your accountant is picking that up on your tax return as an adjustment and as a deduction, because it is in fact tax deductible because you're self-employed.
Thank you very much there, Bob. Okay, and this next question, Dr. Ho, if you want to hire your child to work in the business, do they have to be an employee, or can you pay them as an independent contractor with a 1099?
It would be very difficult to have a child be an independent contractor with a 1099. I think the one tiny example that I've seen where that was possible was if they were actually an actor in the Screen Actors Guild, and you were using them for their image and in commercials and things like that, and they were represented, again, either by an attorney or an agent. They could set up their own company and do it that way. But I would tell you that the IRS and even a lot of the states would cry foul if anyone tries to call their child an independent contractor for the work they're doing to help around the office. I mean, they're clearly directed by you and an employee by nature. Going back to that thing, the way we'd highly recommend that people do in fact employ their children. And I always think that the use of their photographic image on your website and things like that is a great way to do it. Everyone would love to whip and beat the kids and make them go to the office and help clean up or do whatever they possibly can, depending on their age. But they could even be 6 months old and being held in your arms and technically be eligible for the use of their image on your website. So you could, we look at the Screen Actors Guild minimums. It's about $2,700 per year per image is what the union rates are. I would argue that I can't tell the difference between a person who's a union and non-union in a picture, so that must be the value of the picture. So if you have a patient brochure, if you have a website, if you've got other areas where your children are prominent in advertising the practice, consider paying them for the use of their image.
Very interesting. Thank you, Bob, for that. This next question is an anonymous one. Was the ERC only available for a minimum number of employees? If you have under that number, then no ERC?
Yeah, but the number was 500. So I think you're probably in good shape. For most dentists, you're in pretty good shape.
Thank you. This next question from Dr. Thomas Phillip. Can Section 179 deductions be spread over multiple years?
Not really. So you cannot pick it up, but what you can do, however, let's just say, and I'll make an example up so I can explain it better. Let's say that I wanted to keep my taxable income in that $70,000 range, as I've been saying throughout tonight. And if I took my entire piece of equipment and wrote it off, I would be down to zero. Maybe I bought $300,000 worth of equipment, whatever the number would be. Even if it was one piece of equipment that was $300,000 or whatever, you can elect just to take a certain portion for 179. So let's just say that you bought a new CAD CAM system. You would be able to say, well, I just want this much of it to be 179. What happens then is the rest of it is deducted over 5 years. So it would be, well, some of it's deducted this year because this is the year of purchase, plus the 179, and then 4 more years thereafter until you can take the entire deduction. So you don't really have a chance to just say, well, I'm going to take this much this year, so much next year, whatever. The initial year is the one where you get to pick how much of the 179 you take.
Thanks for that clarification. This is a comment. You are the man, Bob. Go ADCPA! Exclamation point.
Well, it's just a bunch of accounting nerds out there that really do know mesial from distal, and so we're a strange bunch. But we've been happily helping dentists for many years. So yeah.
Thank you. This next one is from Dr. Ryan Allman. I have just built out an office this year and moved in May. So I need to go to the details with the GC and find out all my costs that aren't the drywall, etc. So I can get deductions for the cost segregation analysis and get deductions.
Lost her, but Bob, can you hear me?
Yes.
Oh, can you hear me? No?
Yeah.
Hello?
Hello, can you hear me?
Oh yeah, I hear you perfectly. Sorry, did I
good.
go out? Can you guys hear me?
Okay. I think we're so doctor, I can tell you that it's not as important to get the general contractor's breakdown as it is. The IRS has a very specific process that you're supposed to use. you're actually supposed to hire an engineering firm. There's lots of them out there that do cost segregation studies for you, because they know the general contractor would say anything you want them to say, right? If you spend $1 million in a building, they'd be saying, yeah, the wiring was $990,000, the rest was, $10. They already got paid. They don't care. So they know that the contractor may not be the most reliable source of the exact allocation. What they want you to do is have an independent engineering firm look at that. They take the prints, they look at all the square footage, they'll take the guide from the general contractor of what was spent. But they're actually looking at linear feet of drywall for this, exactly how much plumbing there was for that. So they're looking at all the schematics on that print, and they do the deductions. Typical study like that, depending on the size of a building, the minimum is around $5,000. They can go up as high as $8,000, $9,000. But I would tell you that if you can wind up in that, my one example of just $1 million building, if you can wind up with $80,000 in tax deductions that are sped up, it's certainly worth $5,000 to $10,000 in engineering fees to get the proper study done. Because then you come back, what they come back with is a telephone book of documentation on how they did the calculation. And I've never had the IRS ever try to overturn one of these that was done by a formal engineering firm. They've always accepted them under audit. So that's really the way to go. And you have my email up there. I can send you some recommendations if you're looking for a firm.
Thank you so much, Bob. And I also added your email into the chat for everyone to copy and paste as well. This next question is also from Dr. Allman. Also, is software like Exocad tax deductible?
Yes, software is also tax deductible, correct.
This next question from an anonymous attendee: how do you best handle the purchase of an auto?
Well, we could do an entire webinar on that whole thing. I would tell you that for the most clients, you want to really take a look at leasing as compared to purchasing for anything that's not one of the big 6,000-pound behemoths that are more immediately tax deductible. We can go on a long explanation of why that might be beneficial, but in many cases it can be very beneficial. And either way, perhaps if you lease a car or whatever, what you want to do is probably lease the car in your name and then have a corporate resolution to assign that lease, that responsibility to the corporation to make payment. The benefit is that you're now still using your home auto and perhaps bundling home and auto insurance together for discounts. If the practice buys a commercial vehicle and has to buy commercial auto insurance, many times that's significantly higher. And again, you may have lost, the benefit of some of those discounts. So if you assign the lease or assign this responsibility, if you buy the car outright, though, the actual practice has to be the owner of in order to depreciate it. That invoice for the vehicle has to have the practice name on it, not the doctor's name. So make sure that if you want to tax deduct your car, that you actually title it correctly and do it that way. But again, that's one of the reasons why I really am kind of a fan of leasing, because there's also a thing called a custom lease where you can actually on purpose lower your residual value, which means your monthly lease payments go up on purpose, which makes your tax deduction go up. And then you basically have the option to buy that car for maybe less than its fair market value at the end of the lease. So all those can be strategies, when it comes to buying a car.
Thank you so much. This next question from Dr. Sari Clare: will this recording be provided to attendees? Yes, this recording will be going out. The recording of this webinar will be going out to everyone who's registered over the coming week. So if you registered, you will be receiving it. We still have a few more minutes and we'd love to get more questions from the audience. So we invite you to please go ahead and type them into the Q&A chat at the bottom of your screen. While we wait for those questions, Bob, is there anything else that is a common question that you haven't received yet tonight?
Well, not really. I think the biggest thing is just planning early. Like I said, that it's really important not to be trying to do this on December 31st. Buying equipment, it needs to be here, it needs to be in service, and so these are all decisions that need to be made very quickly. I will tell you that there are certainly situations where we have clients who have purchased equipment that I don't know if it was unboxed or if it was unplugged in or not by December 31st, and it's paid for. So I have a feeling there's a lot of people that may stretch that rule, but the correct answer is it has to be placed in service this year. So now's the time to pull the trigger and make those decisions on whatever technology or other improvements you're looking to make to the practice. It can definitely have a big deduction. Let me say, while we have another minute, though, one of the other things that I see quite often overlooked, the IRS does have what they call the de minimis rule. Any equipment purchased under $2,500 can be immediately tax deduct as if it was just supplies. So let's say I bought 5 new computers that were $2,000 each and redid all my operatories in my office. So I have a $10,000 check written to the IT company to buy hardware. They are still all immediately tax deductible as office supplies because each one of those individual items on that invoice was less than $2,500. So if you're talking about those kinds of things, remember that you don't have to worry about Section 179 or bonus or anything like that. Those things were immediately tax deductible. So again, if it's maybe loops, maybe some other hand pieces, maybe things like that, those would all be immediately tax deducted as dental supplies, not equipment. You want to put them in a separate category on your P&L called small equipment under 2,500 so that you know that it's not really the general operating expense for dental supplies. Otherwise, it kind of skews what your metrics when you're trying to look for that. But don't waste time trying to make that equipment when it's not really technically need to be equipment.
Thank you so much, Bob. And we did get a few more questions. Can you hire your child even if they are under 14 years old?
Yes. So the child labor laws in most states don't apply to parents who can hire their children. So the answer is yes. You can hire them. Again, as I mentioned, the easy thing to do is to use their image. But if they're 14 and they're capable of doing tasks around the office that would be useful to you, it's a great way to put them on the payroll. Because again, for those of you, depending on whether you're a Schedule C or an S Corp or whatever, there might not even be any Social Security or Medicare taxes you're required to pay, nor federal unemployment or state unemployment tax on child wages. And yet they're still tax deductible to the practice. So rather than reaching what I call a hip national bank and taking the money out of your wallet to buy those new sneakers for your 14-year-old, you might want to consider making them come to the office and work for it and be able to tax deduct the money you gave them to buy those.
Thank you. This question is from Dr. Parimal Panchal. What are the changes to limits for the 6,000-pound vehicles?
There really aren't any changes to the limits. It's an immediate $25,000 tax deduction. It's still a gross vehicle weight of 6,000 pounds or more. And if you look up the vehicle, if you actually Google 6,000 GVW vehicles, several websites come up with a whole list of what they are. It's clearly the Ford Explorer, the Cadillac Escalade, Mercedes G-Wagons. I mean, all the really big SUVs, as long as they're more than 6,000 pounds GVW, they qualify in that special rule.
And this next question from Dr. Eleanor de Guzman. What are the advantages of getting a defined benefit plan?
The advantages of the defined benefit are just a much higher potential write-off for the contribution. Remember that the defined contribution plans have much lower limits. The defined benefit plans that we talked about can be as high as $200,000, $300,000, $400,000 just for the owner doctor. And so those limits are significantly higher. So again, if your goals are not being met by the current plan, and you've got a lot of taxable income, and you've also got the cash flow to fund it, those defined benefit plans can be a really good tool for also lowering your taxable income.
Thank you. This next question, for a cost segregation survey, what type of engineering firm is used?
There are a lot of specialty engineering firms. I mean, we have a couple that we've used in the past. Some large accounting firms even have their own engineers and specialists on staff that do them. Again, if you have my email address there, you can shoot it to me and tell me a little bit about your project, and I can tell you probably where you might want to go to look for that engineering firm.
Was ERC worth applying for only a single employee who went on unemployment during COVID?
If they went on unemployment and you did not give them any vacation pay or any carryover pay at all during that time period, it's unlikely that it's going to turn out to be valuable. But what you have to do is look again at that exact time period, because if the minute the mandate was shut down, you had your employee go on unemployment, that whole period of the mandate does not qualify. Now what you have to go back and look at, though, is, well, once we came back and I looked at my PPP loan money, and I looked at the loss in revenue that I had because of that, if I qualify for that, I may still be eligible for that $5,000 in 2020 and up to $21,000 in 2021. So it's definitely worth looking at and doing the calculation. It really depends on whether you had that drop in revenue that would trigger the value of that credit.
Thank you. This next question, do computers and new servers fall under 179?
Again, servers certainly would, because they're over that 2,500, but any individual laptop, desktop, monitor, things like that, any one piece of technical equipment that is under $2,500 doesn't have to be subject to 179. You can write it off as office supplies.
If this question from Dr. Esmaili, if patient did not pay their copay or cannot collect money, is that considered a loss?
No, because most doctors are on what's called a cash basis, which just means if I never receive money, I never have income. I do get this question all the time, but well, what if I wound up, seeing a patient and never get paid? Can I write that off? But you have actually written it off because you never claimed the income. If you were on a different tax basis where, like, the large corporations would be required to show income the minute the patient left the seat, of the operatory, and then if they had bad debt, they could get it written off. But no, on a cash basis, not getting paid is the deduction that you get.
And this next question from an anonymous attendee, I rented my vacation home for 1 month this summer. How do I report that for tax purposes? Are there expenses that I can deduct against income?
Yeah, so you would prorate the expenses you had for all the utilities and a lot of costs. You could even have travel costs to get to your vacation home, to arrange for that rental. Attorney's costs if you had a lease prepared. There could be quite a few expenses that are deductible associated with that rental. Anything you incurred during that period of rental and anything you incurred because of you renting it, the advertising, whatever it was that went along with that would be tax deductible.
Thank you. This next one, is there any way to pay college tuition for a child and make any of it tax deductible?
The short answer is not really, because there is a way through a corporation to have an educational benefit allowance. The problem is that if you do it for one employee, if you have your child as an employee, that program has to be eligible for all your employees. So it's very expensive, let's say, to potentially do it that way. You'd have to have a very special set of circumstances for that to be something you could do.
This is a question from Dr. Susan Ho. If you get ERTC for 2020 in 2022, how long do you have before needing an amendment for tax year 2020?
Well, 2020 has to be amended within 3 years of the date it was filed. So if you filed your tax return on time on April 15th of 2021 for 2020, then you have until April 15th of 2024 to amend. If you file an extension, you might be out till October 15th of 2024.
And thank you so much. Those are all the questions we have.
Thank you both. Bob, thank you for all the time tonight and all the expertise. I've said it once and I'll say it again. I'm always amazed at your ability to field all those questions so eloquently and so thoroughly. And thank you to everyone and all the attendees for all of those questions and for your attendance tonight. A couple of quick housekeeping things. We will be sending out a link to the recording for the webinar. You'll automatically receive that as a registrant, and that should go out in about a week or so. So again, thank you very much for joining this evening.